Good afternoon. Thank you for being here, and thank you, 𝐸𝐴 and team, for getting this done. 5x in 5 years. It sounds bold, maybe even ambitious, but in a country like ours, in India, it's not unrealistic. We are at the intersection of structural reform, digital acceleration, manufacturing resurgence, and a deepening capital market. The question is not whether wealth will be created, it's who will create it and how. Today, we're talking about the alpha makers of India, you guys. The investment managers who identify inflection points early, allocate capital with conviction, and ride volatility with discipline. So what separates sustainable 5x stories from short-term hype? Is it sector selection, capital efficiency, governance, timing, a combination of all of these? What is it? On the panel today, with me today are managers who have just not participated in this wave of 5x, but anticipated and captured it through distinct discipline strategies. Today we'll explore more where the next wave of returns will come from and what it's going to take to capture them for the next 5 years. I know we have limited time, so we'll try and cover as much as we can. Get into the interaction. My first question is for all of you. You can take them in sequential order. Delivering 5x in 5 years, that's nearly a 38% CAGR. It's obviously an exceptional achievement. It clearly takes more than favorable market conditions, and I'm sure you had some turbulence along the way. Such performances, like I mentioned in my introduction, requires clarity for sure, requires discipline for sure, requires identification of scalable businesses in the space that we operate in, requires disciplined capital allocation, it requires liquidity awareness, because that's one of the key features where you can get stuck. And then, most importantly, it also requires the conviction to exit before the crowd. When you think back to those 5 years, what were the few big bets or calls that really made a difference for you? And what do you feel you got really right? Let's start with Ron. Thank you so much. One interesting fact that we had while thinking about this was that out of the 7.5 years of our journey, market has performed only 2.5 years. So that's okay. So you have made money in 2.5 years, and 5 years will not be. Like last 1 year has not been that. So yes, it has been a lot of conviction, a lot of standing. When even if there are drawdowns, you have to stand. You have to be disciplined. You have to continuously be that stress test of the portfolio that you are in. I think we have done when we started. I really remember we made a lot of investment. We invested in 𝐸𝐴, we invested in food movers, Balaji Amines. We've delivered over 50 multi-billion since the last 7 years. It has been a lot of conviction. There have been times when the portfolio company has fallen by more than 50% at a time. There have been times when market was outperforming, but that company, like Post Motors, it took us 3-4 years for us to actually the stock to come back and then deliver it. But when it delivered amazing returns for us. So there were times when the company was promising something and that delivery of that project or that particular thing took a lot of time. And it took 3 years. The project was to be delivered in 1 year. It took 3 years for the project to deliver to stand in that company and keep on driving the management. So it has been a lot of discipline. It has been a lot of commitment. It has been a lot of conviction that has played a very vital role. And definitely, when you are creating a portfolio management, public fund management, you have to have a disciplined approach in terms of your capital allocation, staggering the investments, keeping a proper diversification. I think that obviously matters. Times like these, what we are additionally also been doing is that a lot of stocks have fallen, some stocks have fallen, are looking slightly weak in terms of how things are evolving. You have to do the easy and get back to the companies which are going to do well in the future. So you have to continuously work, right? It's a AI age. We see a lot of our investors also going on 𝐻𝐵, putting our portfolios over there, and telling us that hey, this stock and this stock and this stock and this. So I think it is a very dynamic, evolving kind of ecosystem. You have to be on top of it. You have to be on ground. You have to do a lot of scuttlebutt in this kind of investing, and there definitely discipline and conviction stays.
Fantastic. One thing that comes out is when you have the results to back you, all the processes seem valid. So, discipline, of course, is one of the key factors for any fund manager, especially in your space. More importantly, I think it's also a part of your personality where you have to have patience, like you mentioned, in years and months where you don't make money. So it's not easy to kind of navigate through those months. I'd like to hear from you, Pawan. May have a similar journey.
Thanks, Anish. In the second one, I think 3 players will be in charge. You can't have different attributes. So, because very basically summarized key attributes that is required to do consistent performance on a consistent basis. Just to add to that, I think what after is identify certain trends and really early. About balance and force motors, which kind of change balance of the because of the we had several stories with companies like H1H. So really as a theme was there in the meeting. We were to pick up the theme early on. The core what's looking for us is identifying this sort of manufacturing piece in the world. That's transformation. And just to put that in context, if you look at global history, economies which went through massive industrialization, whether it was US in the mid-20s, or Europe in the mid-50s, or Japan, Korea in the 60s, 70s, or China in the early 2000s, they all created disproportionately well when these economies went through massive industrialization. And I guess somewhere or the other, a lot of us have been beneficiaries of that as India is now looking to find space in the global. From just 2.5% global merchandise trade, especially we are looking to get to at least about 5-7%. That's a huge change in the themes of import substitution, themes of infra ancillaries, and the way the execution has been changing. I'm sure a lot of these guys will be traveling to Dubai. You see some of the infra projects they will come up and they have been absolutely unprecedented. Now, seeing these kind of changes on the ground in the way businesses have been done is what leads into this kind of discussion. So you have to be there at the ground to understand what's happening and be courageous enough to commit the capital before it gets into the agenda. I think that's what it is.
Again, like I said, you have the returns to back it. So I think that's some fair points that you made, and I think that also concentration of your portfolio, which will probably address the next set of questions, is something that you got right from my observation. We move to Vijay. Vijay, what do you have to say?
Thank you, Dinesh. Thank you, 𝐺𝐻, for this. Yes, I think what has worked for us is sticking to our core, which has been understanding a particular business or identifying a particular field. So, I think the question was, do you know what has worked for us in the last 5 years and what has worked for us has been whatever we have done. So, I think, identifying themes early where there is going to be a lot of spending in terms of payback, in terms of total addressable market, which is very, very large. And then finding out companies which will do well and building conviction by meeting doing every possible channel check, right from raw material supplier to end customer to banker, get his whole journey, the founder's journey, and then getting what and building. So anybody who starts, it takes time for him to grow. Today, if you started something, the child, becomes 1, 2, then 3. It takes all the journey. There are many ups and downs in that journey. So taking to that journey and building off has made money. So there are 1,000 ways that you say make money. What has worked for us is identifying needs first, then doing a meeting management, and building on with conviction what their capability is in that particular sector. And in the addressable market is very, very large. And even if competition comes, there's good enough for everybody to succeed. Identify early and hold on for longer term has been well for us. And family also, we've given them lessons for our 30, 35 years, and that's how we create well for ourselves. That is what we are offering to the DMS is a recent consultancy started in 2018. We have a very, very clear way we generated it for ourselves. And we keep, telling people that this is the kind of generational that is getting created to equity, which is one of the most flexible and most important. Because I am not taking any other asset, but I am saying this can be a bias which I have. It has been to be amazing. Then getting to the core is one important thing. And more than this, I think, again, one more thing is we have been doing for our the market for us, like as I've seen 2001, 2008. So, more than identifying companies and understanding them, it is about maintaining your mind as to how to behave in certain situations when things are going other way. And teaching that to the client. The client doesn't want to understand how the business is doing, why it's working now. He wants to understand that everything is okay. You are present, you need to convince your client. Very, very important to keep defining yourself in your mind and your behavior when things are not right. That is what will help us.
Interestingly, you mentioned a few things that I have heard from some of your presentations. So I will ask you back another question, which is a follow-up. I have observed you often referring to a 4P or your 4-pillar framework which you operate. What are these pillars? Just explain what these pillars mean to your strategy. And have you built this process for an efficient mechanism of portfolio construction? You also mentioned in your presentations that all 4 are necessary for long-term compounding. Throw some light on this philosophy.
Thank you for the question. So I believe having a process is important for anything you do in life. So this is the process which we form. So the first thing is out of micro, macro, whatever we need, we first identify a sector. So once your sector is identified, then why we need companies, we apply these 4 P strategies, and the first P is the promoter. So the promoter has to be very, very capable, very, very good at what he is doing. First generation, second generation, doesn't matter. As far as he knows each and everything about his business and his competitors also. because knowing yourself and knowing your competitors is equally important. So capability, being in a sector which is going to do well. So the first thing with integrity. So we understand the journey right from the start about the founder, how he has behaved, why in the journey, every journey has up and down. So his behavior, why he was down and why he was up, is also very, very important. So the kind of network we do a lot of challenge checks in terms of how he has behaved in his journey, whether he's cheated anybody or done anything wrong. Because eventually what we are going to own is a minority shareholding in the company. He is going to own the majority. So if he has done something wrong with the minority shareholder, corporate governance is a complete rule. So 50% of our first fee is 50%, which is if we don't get that right, then other three fees are not good for also. That is what Warren Buffett also has mentioned. You cannot do good business in the bad business. So that is first. Then it's the product. Whether the product is good enough, obviously we studied the industry and then the product has to have some mode in terms of what he has created and whether he understands that product and he can change and is flexible or not. And that product has some mode or not. That is 20%. Then again there is profitability, whether there are decent margins in that or not. And because anything which will scale, obviously there will be competition and the margin will be hit. So if there is profitability right now in the business which can be hurt but not to a level where you're not comfortable. The third is profitability, that is again 20%. And final 10% is right, but it is also relevant because after getting everything right, if you overpay for anything, you'll never make money. So the price also is as important. So when all the check boxes are ticked, that is why you have to scroll through hundreds of companies and eventually boil down to 10, 12, 15 stocks will be good. So once all of them are there, the small piece strategy is hit correctly, and when we allocate money to it, and that is really work for us.
Just recap that for us. So it's promoter,
product, profitability, and price.
So this is an interesting one. This is to Pawan. You often describe your approach as private equity style. Private equity style research within the public markets. Practically, what does that mean on the ground? In terms of sourcing, diligence, management access, underwriting, and portfolio construction. And how is that different to how traditional small cap investors?
Interestingly, traditional small cap investing is more to do with catching the moment, because this is a genre where you see stock prices moving extremely fast. And the greed of that quick money is what becomes the parameter decision. So most people end up looking at the stock price as a parameter for decision making. If the price is up, the stock seems to be good. If the price is down, everybody starts pricing the stock. So that's when people very different. If we say private equity approach to public market investing, private equity essentially has four key features. One, you identify really early, because that gives you a huge advantage. Second, your ability to see through growth for very, very long periods of time. When you say long periods, classically golden periods would be between 6 to 7 years. Third is focus on the cash flows, because that's what makes or breaks a company. So completely focused on cash flows. Fifth, fourth, then based on the value discovery premium. Because if you are buying early, you always will have an ability to capture that value discovery premium. That's what adds up to significant information. If people are buying stocks which everybody is talking about, most likely the stocks will be fully discovered. If you buy fully discovered stocks, there's very little room for significant information. So in terms of our sourcing, when we have a lot of experience because we take a lot of market players, a large part of our investments actually come from our network within the industry. When you do this kind of investing, then you understand the business extremely well on the ground, and you have comfort with the management. These are the two key components. Probably very similar to what we just spoke about. But that gives you a huge amount of comfort in terms of being able to hold the business for 5 6 years. Looking at the growth again becomes extremely important. We've had a lot of cases where businesses have taken 2 3 years before they end up delivering. To us, that's like akin to having a Chinese plan, where you may not see the product coming out anywhere in the first 3 4 years. And suddenly in the 5th year, you will get a 10 feet present. We've seen enough and more because, from our perspective, what is happening in that silent phase when nobody is looking at the stock is these businesses are strengthening their roots, which is not generally visible to a retail investor because they're looking at the stock price. The stock price is not moving, but it's not moving. But we've seen companies which are silently strengthening the balance sheets, debt equity ratios are getting lower by the day, operating prices are getting better, but stock price will not happen. These become very, very interesting opportunities. Sometimes picking up businesses which are the far end of the commercial span of the CapEx expansion. Right? Now, during if it's a 2 year, 3 year CapEx cycle, balance sheets probably would have slowed. And from a market's perspective, that's not a good risk. So again, you will probably find stock price not moving as well in the recent history. But if you suddenly have capacity which has gone up 3 folds, you are in for a significant ride. So identifying these kind of things is where the work happens. The biggest calculation actually happens when you are buying a 10 ROE and see that going up to 25%. Most investors generally will start with businesses which are 15, 20 ROE and hope that the ROE sustains. So let it goes up. It's very rare that you have 25 ROE to 25. But the wealth creation actually happens when you have reasons and identify that why a 10 ROE. That's where the huge wealth creation happens. Of course, as a private equity fund, and I come from private markets in that background, a lot of these companies, when they are scaling up, they require a lot of handholding. Handholding not in terms of teaching them how to do business, but it's a mindset level that you have to probably educate the promoter to turn some things and behave in a particular manner. 1,000 crore company going to a 5,000 crore top line, it probably requires professional management. Now, opening up the mindset to see, control, and build professionals, give them insights, that itself is a huge task. It doesn't come in hands. And people who are able to do that thing, they are the ones who are able to successfully execute. So, mapping the execution capability to the opportunity is extremely important, especially when you are doing business. Sometimes it is even succession planning. We see enough and more companies, right, from the largest business companies in the country going on to doing succession plans on. We are buying into small cap companies which are decades, 3 decades in operating history. These things become very, very sensitive. Addressing these things or playing a catalyst role in these kind of things is extremely important. Cross-managing the portfolio, these are the lower value expand. But that all of this collectively adds up in the whole value of the organization. And of course, like I mentioned earlier, the value discovery, a lot of these companies remain under-researched. That's classically how a private equity makes money, right? Because you get to capture the value discovery premium. So just giving them advices or recommendations to the right IR firms, or getting access to the right institutional investors. If you come to think of it, all institutional investors are going for choices. To even get a half an hour attention from a multi-billion-dollar fund manager is a task. Why should you even look at it? And to play that catalyst role sometimes can change the future of the company. It leads into substantial value discovery. This is what classically we did as a private equity investor. You could even do different companies for IPO. Yeah, that's what I can say. But playing a catalyst role in the entire value discovery premium is again a huge value add, a software value add. So that's what both things are. How much of it was familiarity because of your background. I think that's a huge advantage because I started my career as a growth private equity investor back in 2001. Started with Morgan Stanley in 98 and then worked with even for a couple of years. And was fortunate enough to be very early on as a growth private equity investor. And I've seen a lot of these companies scale up 10x, 20x, 50x, 100x with the kind of execution. So we are both of those companies handholding them, trying to leverage the same experience in identifying.
Well, on a lighter note, as I say, it works when it works. It's working clearly. Markets is sometimes good, sometimes all three areas. Performance is good. And I'm saying that with retrospect, with respect to the kind of markets that we have been navigating for the last few years. You know, 2025 has been a tough year for small and mid caps. So, this question is actually for Deva. How have you navigated the fund over the last few quarters and considering where we are now? Where do you see your alpha getting rate over the next 5 years? So first of all, I very much resonate very much. It's a lot about investing in the person. It's a lot about understanding the things. I think very much resonate with what you said. Over the last few quarters have not been everyone knows that they have been bad. So in these kind of times, you have to get back to the management on a regular basis to understand how they are evolving. As Bhavanti said, that a lot of companies use these times to get solid on the ground. So we've been talking to every company that is there in the portfolio, trying to understand how they are trying to navigate. Are there any vulnerabilities because of the projects? Are there any supply chain issues? We've been closely working with them. I think that these all are your babies. You have to continuously be in touch and try and help them navigate wherever it is required. So we've been trying to do that in certain cases where the companies have seen some weaknesses or prolonged weaknesses. We have sought in a way reject and gotten to stocks which are slightly more solid in terms of their outlook. So wherever the market recovers, you will have a higher recovery in those kind of stocks. So you do a lot of stress test on the portfolios on various scenarios. So it's a regular exercise we keep on doing. Over the next few quarters or few years, we think that we were early backers with KLI manufacturing. We also, I think, this kind of portfolios we want to build. We think that the story is going to be very good going forward from here. Because even yesterday I was looking at 𝐵𝐸𝐿's statement that Switzerland has said that Switzerland and for 3 other countries they are going to invest $100 billion as FDI into India. You're going to see EU trade deal coming up by the end of 2026 is what he's saying. By mid of 2026, we are going to see UK trade deal coming up. By US, the tariffs are implemented on an immediate basis. I think how we are placed geopolitically, if you look at sectors like textile was India was at disadvantage of 15 to 20% on textiles versus say a Bangladesh, Pakistan, and still these companies are profitable. And when you go, when you have zero duties with EU, when you have level playing field with UK, US,
just imagine what kind of profitability these kind of companies they survived when they were in a cost disadvantage. And when you are having an advantage, I think these companies are going to do fairly well. So a lot of manufacturing has capacity. Because I think that AI will disrupt technology services, but manufacturing it is very difficult because you have to buy land, you have to set up the factory, you have to get the connections, you have to get the licenses. In 6 5 years, it cannot be replicated by AI. You can yes, you can have robots, you can improve the processes, but I think companies having capacities and with the kind of budget and also the kind of push and the kind of opportunities that are coming up, I think a lot of these capacities will get booked in the coming quarters as we see implementations of these FTAs getting here. So it will be a lot about companies able to increase their capacity over the coming years. So the companies who are able to increase their capacity over the coming years are going to do fairly well. So we are trying to position ourselves in companies which are very strong, which are having which have valuations are correct, valuations are comfortable, as well as these companies who have modes in terms of the manufacturing capacity. So a lot of manufacturing plays we are focusing on going forward. And I think defense, electronics, auto components, pharma, chemicals, textile, all sort of manufacturing here. Very well to keep them and trying to understand the kind of opportunities that are there.
When you deliver the there are questions you can ask to us why you got it right, how you got it right, or why you got it right, how you got it right. But for the first, you can see we have a little bit of time left. I'm going to ask you what I think is in terms of priority, an important question. This is a research-based question. So, and this has always been on my mind, especially when I talk to all the fund managers that operate in the small and micro cap space. Earlier, a lot of small cap alpha came from information asymmetry, simply knowing something that the market does not know, or the market did not know. Today, disclosures are better, coverage is wider, information travels fast. That edge isn't as obvious anymore. So where does your edge really come from now? And how have you tweaked or evolved your research process to stay ahead in a market that's far more transparent and competitive? We'll have to rush through the answer because I can see that we have very little time left, but probably the gist of the research bit, you can start with you.
All of us are leveraging these questions. We are often quickly analyze things. I think reactors is a very good space where private equity kind of investing in the small caps can create a lot of value. We meet a lot of companies and we see a lot of values in those kind of investing reactors or 6 months. Or there is a lot of value to be made. So yeah, we are leveraging technology as much as we can. It's a lot of information that is available. And obviously the products. I think products have also differentiated us a lot. There's a very interesting product that we have in the fund. It's been 7 years, we've not scaled, we've not deliberately scaled it because we've never positioned it as a core fund. But that fund has delivered 32% CAGR in the last 7.5 years. And last 1 year CAGR was also 10%. So I think it's a simple dividend yielding fund, 3.5% dividend yield, but a very niche kind of a product. So I think product differentiation also sometimes creates an
It's more to do with the right information is available to everybody and very faster. I think differentiation is in terms of what to do with the interpretation. It's like reading data, everybody reads data, everybody reads data. and how many people implement it. So if you come to think of it, beyond 700 companies which are researched, it else is available on only social media. You read those two lines and you're reaching conclusions. That's not what information is all about. So spending time and weight in the balance sheets, that's why the real edge is. We spend a lot of time on the ground understanding business trends and other
Vijay?
Agree to what Pawan said. Basically, it's not a two-liner which you can understand. So deep diving, and then, as you mentioned, there are only 1,000 companies or 700 companies which are researched, and other 2,000 are not. So you have to find value where the inefficiency is lying, and we don't have billions of dollars to deploy right now. So it is easy for us to find those opportunities, and India being a 1.4 people place where everybody is aspiring to go. So find those 12, 15, 20 companies which are going to do well better than the others is not that much of a task. So it's just more to do with your research in terms of how early you can identify. As you mentioned, I don't agree. Information is available for everybody. I really don't agree to that. I mean, how much time does everybody have to put on this research? I mean, hardly anything. You have so much data, so much social media, so much things to do that even after it's available, you have to read it, right? There are books printed every year, there are 10,000 books printed every year, but not everybody has time to read them. I feel we still have the edge because we are doing consistently only this, where others are trying to just navigate to some information in that particular thing and trying to capitalize